Good morning, good afternoon, everyone, and welcome to Continuation Pattern Capitalizing on Market Momentum. My name is Ali Mortazavi, and I'm the head of training and education at Aranza Broker. And I'm so glad to be with you today with this uh, informative webinar, hopefully, about the continuation patterns. Please, if you can see my presentation and you can hear my voice clearly, give me some confirmation to proceed further. Thank you. Okay, as you know, this webinar is brought to you by Aranta Broker, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with all types of clients, partners, traders. Okay, before we proceed, it's important to take a moment to address our general disclaimer. Trading in Forex and CFDs carries a high level of risk and may not be suitable for all investors. So please be aware that all of the content that we are providing during our webinars are solely for educational purposes, and please don't take them as any kinds of investment advice, because as you know better, CFD products are really risky and it needs a very personal and precise due diligence and assessment of your targets, your capital, your knowledge, and also the risk tolerance that uh, you personally gonna have. So okay, without any further ado, let's just jump on our today's content to see what we're going to explore today. As you see here is the outcomes of our webinar. First and foremost, we will explore the concepts of market momentum. This is a key element in Forex trading as it helps us determine the optimal time to enter the market. Understanding market momentum is like having a compass in the vast sea of Forex trading, and it guides us towards potential trading opportunities. And as we move forward, our focus will shift to continuation patterns. These patterns are not just random formations on a chart. Uh, they are significant indicators that measure market momentum and provide insights into whether a trend is likely to resume. In a sense, continuation patterns serve as a bridge connecting our understanding of market momentum with real world trading opportunities. And we will then dive into the world of common continuation patterns such as triangles, wedges, flags, pennants, and rectangles, and you will learn how to identify these patterns, understand their structure, and interpret what they signal into market. But here is where it gets even more interesting. We will discuss how continuation patterns, when combined with momentum indicators, become a powerful tool in identifying trade opportunities. And this combination allows for a more holistic approach to trading, ensuring that you are not just following the patterns, but also aligning with the overall momentum of the market. And finally, we will cover how to interpret and trade these continuation patterns effectively one by one. And remember, while these patterns indicate the potential continuation of a trend, they do not alone dictate market direction. We will emphasize the importance of confirming breakouts with other indicators, projecting potential targets, and managing risks in trades involving continuation patterns. I hope at the end of this webinar, you will have gained a comprehensive understanding of how to leverage continuation patterns and market momentum in Forex trading. So this knowledge will empower you to make informed and strategic trading decisions. So let's set sail on this educational voyage and unlock the secrets of successful forex trading together. Cool. Having established the key learning objectives of this webinar, we now turn our attention to the fundamental concept of market momentum. This concept is crucial in understanding the dynamics of forex markets and forms the basis for identifying continuation patterns. What is market momentum? Market momentum refers to the rate at which the price of a currency pair changes over a period of time, and it's a measure of the velocity of price movements, not just the direction. In forex trading, momentum is indicative of the strength of a trend. A rapidly increasing price suggests a strong momentum, which typically aligns with a strong trend. Conversely, a decrease in the rate of price change can signal weakening momentum, often a precursor to market consolidation or reversal. So, to quantify market momentum, traders utilize various technical indicators. The relative strength index, or RSI, for example, measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a currency pair. The moving average convergence divergence, MACD, is another tool used to reveal changes in the strength, direction, momentum, and duration of a trend. The other one is the stochastic oscillator. Similarly, compares a particular closing price of a currency to a range of its prices over a certain period. And these indicators assist in assessing market conditions and making informed trading decisions. So understanding market momentum is vital. It enhances the trader's ability to anticipate potential continuations or reversals in market trends. So this knowledge is foundational for the subsequent analysis of continuation pattern, where we will apply our understanding of market momentum to identify and interpret these critical formations in forex trading. Building on our understanding of market momentum, we now focus on continuation patterns. A key aspect in the analysis of forex markets, continuation patterns are specific formations that emerge on price charts during a trend. These patterns signal a pause or consolidation into a market, suggesting that after this brief period, the price is likely to continue in the same direction as the prevailing trend. So the characteristics of continuation patterns are distinct. They usually form in the midst of a trend and represent a period where the market takes a breather, consolidating before resuming its prior direction. So this pause is typically marked by a decrease in volatility and trade volume. If in forex trading, the ability to identify these patterns is really invaluable because they provide traders with insights into the likely continuation of a trend, enabling a strategic planning for trade entries and exits. Recognizing these patterns early can give traders a significant advantage in anticipating market movements. Okay, there are several types of continuation patterns, each with unique features and implications. Common examples include triangles, rectangles, flags, and pennants that we will discuss in this webinar later. Understanding the nuances of these patterns is crucial for traders as each offers different signals regarding the continuation of the trend and potential trading opportunities. As we progress through this webinar, we will delve deeper into each of these continuation patterns, exploring their formation characteristics and the trading strategies that can be employed when these patterns are identified. So it's important to understand when and why they emerge in Forex markets. Continuation patterns typically appear during period when a trend experiences a temporary loss of momentum. So uh, this is the point that you can connect the market's momentum to continuation patterns. This loss manifests as a consolidation phase, a key transition in market dynamics. Okay, let's say what is consolidation? It might sound new to you, but don't worry. Consolidation is characterized by a narrowing of the price range and a noticeable reduction in trading volume. This phase reflects a period of indecision among traders, where the previously dominant trend pauses and the forces of supply and demand reach a temporary equilibrium. So the transition from a momentum-driven trend to a consolidation phase is critical to observe. It often signals the formation of a continuation pattern. For traders, monitoring this shift is essential as it precedes the likely resumption of the trend. So you can find a good entry point when you see the momentum is accelerating. So the ability to identify this transition early can provide traders with a strategic advantage. While continuation patterns do not guarantee the future direction of the market, they offer a probabilistic view of what the market might do next. So recognizing these patterns allows traders to prepare for potential trade setups, capitalizing on the resumption of the trend. And this predictive value is what makes continuation patterns an integral tool in the arsenal of Forex traders. So in our next slides, we will explore the construction of these continuation patterns and see how they signal the resumption of the trend, providing traders with valuable insights for their trading strategies. Okay, here let's jump on the common construction of continuation patterns. Guys, continuation patterns are not random formations. They follow a specific construction process within the context of a trend. It doesn't matter if it's an uptrend or a downtrend. Understanding this construction is crucial because based on that, we can identify and capitalize on these patterns effectively. The first element, so you got the point, I guess. The first element of a continuation pattern is the prior trend. This is an, let's say, established movement in one direction, setting the stage for the pattern. Following this, we encounter price consolidation. This is where the price movements become limited and start to form a recognizable pattern. The trading volume typically decreases during this phase and the price range starts to contract. So it is within this consolidation phase that the continuation pattern emerges. Each pattern, be it triangles, rectangles, flags, or pennants, has distinct characteristics. Recognizing these patterns as they form is essential for anticipating the future movement of the market. And then we come to the final phase where in the construction of the continuation pattern, which is the breakout. Okay, this occurs when the price breaks out of the pattern, signifying the end of consolidation and the likely resumption of the prior trend. However, it's crucial to confirm this breakout with other technical indicators to validate the continuation. This confirmation helps in somehow mitigating risk as well, and also increasing the probability of successful trading outcomes. As we proceed, we will delve deeper into the specifics of these patterns, examining their formation characteristics and the strategies for trading them effectively. But please memorize these four phases of emerging a continuation pattern, because if you can't see, for example, the prior trend, or you can't uh, clearly identify the price consolidation, uh, it can, it can be questioning the formation of the pattern. So the consequence movement would be also mm, questioned by the weak elements of formation continuation patterns. Okay, in discussion, the construction of continuation patterns, it's imperative to address a common misconception. Yep, yep. You got me right. Continuation patterns, while indicative of potential trend continuations, do not inherently provide information about the future direction of the market. These patterns primarily signify a pause in the existing trend, but the outcome is really not clear to us. They suggest a probability that the trend may continue post-consolidation, but this is not a guarantee. The actual direction the market takes post-pattern is influenced by somehow many different factors, including economic data, geopolitical events, and overall market sentiment. Therefore, it's important for traders to understand the continuation patterns of tools for probability-based forecasting. They're not, uh, they can't assure us of the exact continuation in the same direction of the prior trend. So they should not be relied upon in isolation. Instead, they should form a part of a larger, more comprehensive trading strategy. And this strategy must integrate other forms of analysis, such as technical indicators, fundamental analysis, and market sentiment evaluation. By combining continuation patterns with these broader analysis techniques, traders can achieve a more holistic understanding of the market, and this approach enhances the ability to predict market direction and identify potential trading opportunities, therefore, thereby increasing the likelihood of success in forex trading. So, transitioning to specific continuation patterns, we start with the symmetrical triangle, a common and significant pattern in forex trading. Let's see what is symmetrical triangle pattern. Very well. Guys, please, if you have any questions so far, please write it down through the chat box that you have, and I will be more than happy to answer them if I know the answer. Okay, perfect. So let's continue with symmetrical triangle pattern. Let's see, the symmetrical triangle is characterized by two converging trend lines with equal slope. Let me turn on my laser point here. Maybe I would be able to show you better nuances here as you see on my presentation. Okay. You see here two converging trend lines of equal slope, almost equal slope, where one is ascending and the other descending. Okay, so this pattern symbolizes a period of indecision in the market where the forces of supply and demand are in a state of equilibrium, making the future price direction uncertain. So the formation of a symmetrical triangle occurs during a trend. You see, we have a prior uptrend, and this price consolidation within this triangle, symmetrical triangle pattern, suggests a market uncertainty, or let's say market indecision. And this is marked by the creation of lower highs and higher lows, which gradually converge to a single point, somewhere like this, for example. Okay, so the symmetrical triangle is unique in that it does not favor bullish or bearish outcome, indicating that a breakout could occur in either direction. When it comes to trading a symmetrical triangle, understanding the breakout rules is essential. Let's see what is a valid breakout. A valid breakout from this pattern should be confirmed by an increase in trading volume, mostly in the stock market, not in Forex, by the way. You can assess the increasing volume by looking at the body of a candlestick, of a breakout candlestick. As we explained before in our previous webinars. Okay, so let's move on. First, we need a confirmation by an increase in trading volume and possibly other technical indicators. For example, like RSI crossing 50 level, or MACD crossing 0 level, or something like that. And this confirmation helps in verifying the strength and direction of the new trend emerging from the pattern. Post-breakout, target rejection is a critical aspect. The common method for estimating the price target is to measure the height of the triangle at its widest part, let's say the widest distance from the highest high and the lowest low of the triangle, which is the base of the triangle. Okay, so the height of the triangle at its widest part, which we call it base, and project this distance from the point of breakout. This projected target is used by traders to set potential take profit levels and effectively manage risk. The breakout can occur to the upside, like here, or to the downside. In that case, you need to project a same length as the base from the breakout point to the downside, if it's from the lower band, or to the upside of the triangle, symmetrical triangle, to project the targets. Okay. Okay, guys, symmetrical triangle with its distinctive features is a versatile tool in Forex trading, okay? And it offers valuable insights, but it has nothing to do with forecasting future market direction. Now, moving forward in our exploration of continuation patterns, we come to the ascending triangle, a pattern indicative of bullish sentiment in the Forex market. And this pattern is identified by a flat upper trend line that acts as resistance and an ascending lower trend line that indicates increasing buying pressure. It usually takes at least 4 touch points through the lines, and we need the 5th point to make a breakout or a rebound from the upper, let's say, boundary of the pattern. Okay. The formation of an ascending triangle is typically seen during an uptrend. Prices make higher lows, reflecting growing optimism among buyers, while the upper trend line shows a price level as sellers are defending strongly. So this tension between buyers and sellers leads to the consolidation phase that forms the ascending triangle. When trading the ascending triangle, it's important to understand the breakout rules. The breakout is generally expected to occur to the upside, pushing through the resistance level. This breakout should be confirmed by an increase in volume and possibly other technical indicators, which helps validates the strength and potential sustainability of the upward movement. In terms of target projection, post-breakout movements can be projected using the heights of the triangle's base again added to the breakout point to estimate the price target to the upside. However, don't forget that it's not the rule of thumb that the breakout will always happen to the upside. It can be, the downside breakout. So in that case, we can project the price targets to the downside by decreasing the length of the base from the breakout price. Okay. So this target projection is a valuable tool for traders because it aids us in setting realistic profit targets and managing trade risk effectively. So you see the ascending triangle is expected to be a bullish implication during a consolidation phase of the prior uptrend. Okay, as we continue our examination of continuation patterns, the descending triangle emerges as a critical pattern, often indicative of bearish sentiment in the forex market, characterized by flat lower trend line and a descending, as you see, upper trend line. The descending triangle signals a potential continuation of a downward trend. This pattern commonly forms during a downtrend, as evidenced by price making lower highs. This suggests that sellers are becoming more aggressive, pushing prices down, while the flat lower trend line indicates a level of support where buying interest is present, but not strong enough to reverse the trend. So the descending triangle highlights the increasing pressure from sellers and the weakening defense by buyers. The rule of trading a descending triangle focus on the breakout, which is typically expected to occur to the downside, breaching the support level. For a trader, confirming this breakout is crucial and should involve, again, an analysis of trading volume and other technical indicators like RSI, moving average, MACD, and so on. And these additional checks help, let's say, ensure the validity of the breakout and the likelihood of a continued downtrend. In setting a price target post-breakout, traders often calculate it as the height of the triangle's base subtracted from the breakout point. And this target, this target projection is instrumental in formulating profit-taking strategies and managing risks. Okay, so now you know that descending triangle with its bearish implications is a vital pattern for forex trader, offering insights into market trends and aiding in the identification of potential downward movement in the market. Okay, advancing our exploration of continuation patterns, we encounter the ascending wedge, a pattern that often signals a potential shift in market dynamics. The ascending wedge is formed by two upward sloping trend lines with the lower line being steeper than the upper one. So this pattern is particularly noteworthy as it usually indicates a loss of momentum in an existing uptrend, hinting at a possible reversal. The ascending wedge develops during an uptrend as prices make higher highs and higher lows, the trend lines drawn along these peaks and troughs converge, suggesting a gradual weakening of the bullish force. This is an important indicator for traders as it signals a shift from a dominant upward trend to potential bearish reversal. So despite the name of the continuation pattern, when trading the ascending wedge, attention should be paid to the breakout, maybe to the opposite direction, which typically occurs to the downside when we have a prior uptrend, for example, in the market. This breakout marking a reversal of the prior uptrend should be confirmed with thorough analysis of trading volume and other technical indicators. These additional measures ensure the authenticity of the breakout and the potential for a trend reversal. In determining the price target post breakout, traders often measure the height of the wedge at its widest point as a base and subtract this from the breakout level. This calculated target assists traders in planning exit strategies as well as effectively managing the associated risks. So the ascending wedge with its implications of a weakening uptrend is a key pattern in forex trading, aiding traders in recognizing and preparing for potential market reversals. Very well. Any questions, guys? Nope, all good. Okay, perfect. So shall we continue to descending wedge patterns? Continuing our journey through the various continuation patterns, we now turn our attention to the descending wedge, a pattern that often signals a change in market sentiment. The descending wedge is identified by two downward sloping trend lines, with the upper line being steeper than the lower. So this pattern is significant as it generally indicates a reduction in the momentum of the downtrend, suggesting a possible bullish reversal. If it happens during an uptrend, okay? This pattern typically develops during a downtrend marked by the formation of lower highs and lower lows. As these points converge, the descending wedge takes shape, signaling a weakening of the bearish pressure. For traders, this pattern is a crucial indicator highlighting a potential shift from a dominant downward trend to an upward reversal. So trading the descending wedge requires a keen eye on the breakout again, which is usually expected to occur to the upside, to, let's say, the opposite direction of the prior trend. If this is a downtrend, you have a prior downtrend. So, excuse me, we can expect the breakout to happen to the upside or vice versa. However, we have the same rule to project the potential targets but never forget to again, to use the trading volume in the stock market or other technical indicators in forex to confirm this breakout, because false breakouts are somehow common during the consolidation phase, because these confirmatory measures are essential to validate the breakouts and the potential for a trend reversal. Good? Very well. Okay, let's delve deeper into the realm of continuation patterns. We encounter flags, a pattern that is particularly relevant in fast-moving markets. Let's see what is flag pattern. Flags are short-term continuation patterns. Excuse me, guys. Yeah, that appears as small rectangles formed by parallel trend lines, sometimes with a positive or negative slopes. Okay, but the point is that they typically emerge following a sharp price movement known as the flagpole and represent a brief consolidation in the market. Flags develop during a strong trends where after a significant price movement, the market enters a consolidation phase, and this phase is marked by limited price fluctuation within a narrow range, resembling a flag on a flagpole. So the consolidation is a period of rest in the markets following the intense volatility that creates the flagpole. The trading of flags revolves around the anticipation of breakouts. These breakouts usually occur in the direction of the preceding sharp price movements. For a trader, confirming these breakouts is crucial again and should involve an analysis of trading volume alongside other technical indicators. So you see, guys, I'm repeating this on each slide because confirming using the other technical indicators is really vital. Don't play with these continuation patterns in their isolation because this is a nature of consolidation phases that price usually moves in a very confusing way. And in real-time markets, you can see the shadows, you can see a big, let's say, long candles body. However, especially if you trade on shorter time frames, might happen a lot. So it's really, really, really important to get confirmation from the other technical tools. Okay, when it comes to setting a price target post breakout, the general method involves measuring the height of the flagpole. Sorry. In the case of a bullish flag, this height is added to the breakout point, while for a bearish flag is subtracted. Okay, so this is a difference. We don't have the price target doesn't have anything to do with the base or with the distance between these parallel lines, but instead we use the prior movement in the market we know as the flagpole, and we usually try to somehow extend this length to the upside, to the breakout side of the flag. So again, this is a valuable tool for traders, aiding in setting profit targets and effectively managing the risk associated with the trade. Flags, with their distinct appearance and implication, are an integral part of a forex trader's toolkit. You may see it a lot on charts, especially when you have a news announcement or in times that there is a very sharp movement in the market regarding the opening of, for example, US market or opening of the European markets. So you see a very sharp movement in the price, and afterward you might see emerging of a lower tops and lower bottoms However, it's usually that small that you can't name it as a downtrend. And you usually need only 4 touch points to the mm, two market tops, to connect them for creating or drawing the upper line, and also to market bottoms. And afterward, you can measure the flagpole, and you can uh, prepare yourself with a trading plan in the event that the market uh, can break this flag and somehow resumes the prior uptrend or downtrend. Okay, moving on to pennants, we delve into another essential continuation pattern in forex trading. Pennants closely resemble small symmetrical triangles and are typically formed after a steep price movement, which is often referred to as the flagpole. So this is another type of flags, but here you see a converging trend lines. These patterns are indicative of a short-term consolidation phase in the market, suggesting an impending continuation of the trend. Okay, pennants usually form during a powerful trend, emerging as a result of a temporary pause in market's momentum following a significant price move. And this pause leads to the formation of converging trend lines, creating a narrow symmetrical triangle shape. The consolidation represented by the pennants is characterized by decreased volume and narrow price movements. When it comes to trading pennants, identifying the breakout direction is crucial. Breakouts generally occur in the same direction as the initial steep price movement. Traders should seek confirmation of this breakout through an analysis of trading volume and other technical indicators, ensuring the breakout's validity and the continuation of the trend. So the price target, again, is typically calculated by measuring the length of the flagpole. For bullish pennants, this length is added to the breakout point, while for bearish pennants, it's subtracted. Okay, very well. Okay, as we explore further, and we are getting to the end of this session today, excuse me for the mistypo here. Let me just yes, sorry, let me just correct it. It must be a rectangle. Yes. Excuse me, guys, for this mistypo here. It's not the pennants. It's not the continuation of the pennants. It's this is the rectangle pattern. Okay, let's see what is rectangle pattern. Yeah, sorry, I couldn't find a way to correct it. Okay, now it's fine. Okay, I'm sorry for that. The rectangle is characterized by price movements confined within parallel support and resistance lines. Okay, this pattern indicates a period where the market is in equilibrium with neither buyers nor sellers gaining the upper hand. The formation of the rectangle occurs within a trend when the price consistently bounces between a clearly defined resistance level at the top and a support level at the bottom. So these horizontal boundaries represent a pause in the prevailing trend as the market participants evaluate and reassess their positions and market dynamics. Trading the rectangle pattern hinges on identifying the direction of the breakout. The breakout can occur either upwards through the resistance line or downwards through the support line. It's crucial for traders to confirm this breakout with an analysis of trading volume and other relevant technical indicators. Again, I'm repeating this. I hope you don't get bored of these comments, but guys, it's really essential. Such information ensures the authenticity of the breakout and provides a clearer picture of the market's intent. To determine a post-breakout price target, traders measure the height of the rectangle and apply this distance between the support and resistance lines of the rectangle from the point of the breakout. Okay, this calculated target is essential for traders to set potential exit points on the upside or the downside. Okay, so the rectangle pattern with its straightforward structure and clear breakout points is an invaluable tool in forex trading, offering insights into periods of market consolidation and potential subsequent movements. Very well, guys, we conclude the segment of our webinar. This is the last, let's say, webinar session that we discussed the chart patterns, and then we will move on to develop the trading strategies in our coming webinars. Please, if you have any question regarding our content in this webinar or the previous one, don't hesitate to write me, maybe here using the chat box, or just email me. You can always watch our previous webinars or on our website, aroundit.com. Thank you so much for staying with me in this evening. I hope to see you all in the next week. Thank you so much. Have a great evening.